All right, Fed is at it. They said they're going to raise interest rates a 1/4 percentage point the other week. And so what does this mean? Well, now that cocktail parties are a thing again, thank you for the world opening up. It feels nice to actually see people. But anyways, I figured it'd be nice to arm you so you could be the smartest person in the room for a moment. So first of all, what is meant when you hear interest rates increase, right? It's sort of a ubiquitous word or term that I don't think everyone really understands. What essentially it means is the Federal Reserve makes a suggestion to banks. Normal banks, Wells Fargo, TD, they have reserves on hand every night. And what they do is there's a certain amount that the Fed makes them have, and the rest they can go lend to other banks with less on hand. So these banks take these funds and they lend them to other banks. Hey, this bank needs some more cash to lend and this bank doesn't. You can lend it and so on and so forth. So that rate has been basically zero for years. And they did that to pump money back into the economy. Now, with what they're saying is, hey, we're going to increase rates and suggest that the banks, lend dollars at a 1/4% to 50%, or 0.25% to 0.5%. That's the going rate. Do they have to do that? No. But the reality is if they don't, well, what's the Fed going to do? They can restrict their money. The money these banks borrow from the Fed in the first place will go up. So generally they fall in line. So now we understand what interest rates movement means. It's really the inner lending between banks in the overnight market of their excess reserves. So now what is affected by the fund rates? Well, basically everything. And I mean basically everything. So what is affected? Well, anything with debt. So your college loans and mortgages and car loans and credit cards and your home equity line of credit that's generally variable rate. So virtually everything is tied to these interest rates. And so as they go up, so will borrowing costs for you, the end consumer. Now, additionally, it's not all terrible. So yeah, it'll be more expensive to borrow. It's also more expensive for companies to borrow and to lend money. So there's not quite as much money in in circulation. But at the end of the day, also interest rates on your savings go up. Bond rates will eventually go up. So it's a sort of a double-edged sword to a degree. It certainly is a less accommodative policy, but a lot of times the Fed does this because the economy's doing better and it needs less accommodative measures. And so they rise rates to get things back in line and let the economy run sort of on its own, which isn't necessarily why they're doing it today, but that is the conventional wisdom. Which leads to the question, why now, why today? So the Fed has a couple mandates. One of the mandates is unemployment, and another big mandate is inflation. So inflation, they have a 2 to 3% target. 2 to 3% is what they're looking to keep inflation at. Today, we're at 2.5 times that, around 7%. So what the Fed's doing is they're raising interest rates to combat inflation. How does that work? So essentially, as rates go up, people borrow less, they save more, and essentially more money leaves the economy being spent and gets saved or not borrowed. So there's less money in circulation when interest rates go up, essentially. And when inflation is rampant the way it is now, it's a great way to combat it. Because if you are a producer of goods and selling goods and services and you want to raise your rates and your prices, well, you can attempt to do that. But now there's less money. So if I have only 75 cents versus $1 to spend, I have to choose more wisely where I'm going to spend it. So you can still choose to raise your rates exorbitantly, but in reality, you're not going to want to do it, because eventually it's going to get to a point where there's much less money in circulation, and I'm going to buy an essential good, not a new record. And so you really want to lower, it'll really help combat inflation. So what's expected moving forward? $1 million question. So we already spoke that they raised rates, the Fed raised rates 0.25%. They're going to meet 6 more times this year and expected to do at least the same. So this means that by the end of the year, you're looking at a 2% lending rate overnight, very possibly. And so we know interest rates are going to go up. We know everything tied to it is going up. So keep an eye on your savings rates. Keep an eye on how you're investing in your bonds. If you have a mortgage, think about, or that's variable, think about locking it in. If you're thinking about buying, maybe do it sooner than later. If you're thinking about refinance, maybe think about doing it sooner than later. So a lot of things are out there. Your home equity line of credit, you may want to pay down a little more, or keep an eye on it, because rates will go up and it will get more expensive. So now when you're at that cocktail party, you can sound a little more intellectual. You can not thank me, because take the information yourself and fake it till you make it. But anyways, hope you enjoyed this. I'm Andrew Rosen, President of Diversified. Stay wealthy, stay healthy, and stay happy. Bye.